Hey guys, thanks for watching, thanks for liking, thanks for sharing the video. Today I just wanted to talk about Fundrise and taxes. Um, we had a lot of some questions about taxes. I wondered myself before I started investing what the tax situation would be. I have a background as being an accountant, so it's always interesting to me, to find out what are my gains after taxes. After all is said and done, what am I actually taking home? So in this video, I just queued up a few points from Fundrise directly, as well as some tax resources for you. So you can go ahead and take a look and see what kind of situation you might be in. The first link is fundrise.com/help, and I'll try to post some down below in the description. They talk about two forms of tax documents that you'll receive, and we'll talk about how both of those will affect what you might pay in taxes. For the first one is really like any of the beginner, the starter portfolios, any of those core investments. The Form 1099 DIV, which is a dividend tax form that they're going to be letting the IRS know that they paid you dividends and letting you know what they told the IRS. And those are going to be for what they call the eREIT, which is one of their main offerings that they have. But then there's another type of document you might receive, which is called a Schedule K1. And this is for any kind of eFund that you might have shares in. And we'll talk about the key differences and how they might affect your taxes. For the first one, which is the dividend income, we have the 1099 div, which is usually going to be, from what I've discovered on Fundrise, the less than $10,000. Any account that's less than the advanced account would allow you to have the 1099 div. You can get this tax form with above the advanced account, but I think it's basically by a selection basis. You would select, hey, am I okay with getting a Schedule K1, or do I want just the 1099 dividend? There's also a difference as far as when you might get it. You might get the 1099 div form a lot earlier in the tax season versus the Schedule K1. I believe it wouldn't come out till March, April timeframe. So you do have to be prepared for that if you like to file your taxes earlier. The Schedule K1, it's also known as Form 1065. It's a partnership form, so we'll talk about that. And they relate this to what they call the eFunds, which I would encourage you to look up on Fundrise website. What is an eFund? What is an eREIT? What's the difference? But usually this is going to be $10,000 or more, or the advanced account or greater, which starts at that $10,000 mark. Now, as for how the dividends are going to be taxed for the 1099 div IRS tax form, and remember, this is just federal income tax that we're talking about here. There's two ways that dividends are normally taxed: qualified dividends, and then we also have long-term capital gains tax rate for those qualified dividends, which is usually a more favorable tax rate than your normal income tax rate. And then the other one is the ordinary dividends, which most dividends fall under, and that's going to be taxed at whatever your taxpayer income tax rate is for your personal situation. Now, there is a little bit of bad news. If you go to this link, fundrise.com/education/REIT-taxes 101, you'll see that most, if not all, taxes that are dividends are not going to be qualified. It says that we do not anticipate that they will declare qualified dividends. Basically, they're saying that all of these dividends for those eREITs are going to be classified as ordinary income. So the other option is if we went with the Schedule K1 Form 1065. Now what this is this is a partner's share of income deductions and credits. So you're a partner with Fundrise on these deals. So that's good and bad. We're not just reporting dividend income. but we're showing any kind of income or loss, any kind of expense, depreciation. Basically, we're taking our share of any of the risks and rewards of ownership of the real estates that are underlying our portfolio with Fundrise. So this can be good or bad, but generally it's seen as a good thing that we take a share, a partnership share of any kind of gains or losses that happen within the portfolio. And this allows you to basically have more deductions, more options for offsetting some of your income and things of that nature. And again, talk with your tax professional, talk with your CPA, or if you have a tax lawyer. Do some research online, do your due diligence on those. So with dividends or K1, 1099 or the K1, what am I going to be paying in taxes? So for federal income tax, we have basically this tax table. You can look at it at the IRS website. I pulled this one off of Fundrise since we were talking about Fundrise. They give some hypothetical examples. But basically, if your taxable income is going to be less than $9,000, you're not going to pay any kind of capital gains tax rate. But your ordinary tax, above this 9,502 is going to be taxed at the 10%, and so on. So you can see like where your income is, your individual income or your joint income, depending on if you're married or single, what your normal tax bracket is. So if your taxable income after all the deductions and everything that you could possibly take is 165 to 315, your ordinary income tax rate for federal purposes would be 24%. Of course, if you make over $500,000 a year, you're going to be in that 37% income rate bracket. So for your ordinary dividends, if you got $1,000 in dividends for the year from Fundrise, you're going to be paying 37% or $3,700 to federal income taxes. So we don't anticipate any of these capital gains tax rates that are more favorable. You would get those, with certain stocks that you hold over a year, or there's also some dividend treatment for that. You can look up the tax treatment for long-term capital gains and short-term capital gains on those. But basically, after all is said and done, after all of your tax deductions, if you boil it down to your taxable income, you're going to be paying these percentages depending on where your taxable income falls on any income reported either from the K1 or from your 1099 dividends tax form. I hope this was helpful. This is kind of like a forward looking video as we're heading into the 2020 tax season. And then hopefully, in about 4 or 5 months, I can actually show you how that plays out on an actual tax return given these rates, and we'll see what our tax rate is, what our effective tax rate is, and to see if it is still a good investment. If we're paying such high percentages, if it's still going to be a good investment to invest in Fundrise. I think it is, and I'll show you a quick thing if you guys don't mind. Let's say we made $10,000 in dividends, or actually I'm sorry. Let's say we want to make 10 to 15%. If I can make 15%, even if I'm paying the highest tax bracket of 37%, and I take that away from our 15%, we're still, after being brutally hit with 37% taxes, we're still hitting 9.45% return after taxes, which is, to me, just tremendously incredible. But I definitely hope to outdo that number, but we'll definitely take a look and see where it goes. Thanks for watching, guys. Thanks for sharing. Let me know if you have any questions or you want to see other videos, or maybe there's another point of view that I didn't take a look at to see how these would affect you. Of course, this doesn't even take into consideration state taxes if you live in a state that does have taxes, or even localities, things of that nature. But thanks, guys. Thanks for watching. Have a good day.